Hi, this is Mike Frosch, and today we're talking about service contract reimbursement insurance for service contract providers. Service contract reimbursement insurance is used by many providers to satisfy various state regulations. As a summary of state regulations, when you form a service contract company, also known as an obligor or a provider, the regulations vary depending upon the state or states where a company plans or intends to operate. Most states do have some form of regulations related to operating as a service contract company. Regulations can generally be broken into 6 distinct areas, from registration with the state, where you actually fill out an application with the state. Definitions are typically contained in the regulations and the statutes. What is a service contract? When can it be sold? How can it be sold? What is not a service contract are a few examples of the definitions. Contract forms and required language get into the actual form the consumer receives. Some states require you to file those forms with the state for approval. And many states have language that needs to be incorporated on areas such as refunds or backing of the contract, for example. Financial requirement regulations typically get into what exactly are the mechanisms to ensure performance under the agreement. What is the backing of the service contract in the state? Reporting requirements. Typical regulations on reporting talk about what information, how often needs to go to the state. And then general consumer protection and consumer law regulations throughout all the states. The financial requirement regulations, they exist to ensure the customer receives the promised benefits. The state effectively wants to know who is going to perform no matter what, and guaranteeing the consumer gets what they purchased. The National Association of Insurance Commissioners, NAIC, has created what is known as a Service Contract Model Act that creates a framework for states to use when they form their own state-level regulations. This act was created over 20 years ago, and many states have utilized parts of it, or some or all of it, in their regulations, and then enhanced it since its original publication over 20 years ago. Each state is different and needs to be reviewed individually. These are complex state-by-state issues, and you do need to perform a thorough evaluation and review. Sample state financial requirement options. What we've done here is we're going to list some excerpts from the State of Illinois Service Contract Act. This act generally follows the National Association of Insurance Commissioners Service Contract Model Act, so it's a good example to take a look at. The full act is available at the URL listed. For the sake of today's discussion, we've carved out some excerpts specifically related to Section 15, Financial Requirements. This is by no means intended to be a comprehensive review of the act or the statutes or even Section 15. It's merely meant to be summary level to show the types of options that are available. The 3 options that are listed, number 1 is that a service contract provider is insured under a service contract reimbursement insurance policy. Number 2 is the service contract provider maintains a funded reserve account for all the obligations that are outstanding in that state. The reserves need to be, in this example, 40% of the gross consideration received, which is what the consumer pays, less claims that are paid, for all the service contracts that are then active and in force. In addition to the 40%, an additional $25,000 or 5% also needs to be held, and it needs to be placed in trust with the Director of Insurance as an additional deposit. So it's $25,000 minimum or 5%, whichever is the greater number, and that is along with the 40%. That's the second option. The third option is a service contract provider can show that its parent company, in accordance with some other statutes, maintains a net worth or stockholders' equity of $100 million or above. There are other additional requirements as to how you demonstrate that, but those are really the 3 choices: a reimbursement service contract reimbursement insurance policy, a 40% plus 5% reserve, or the $100 million parental net worth as a provider or its parent company. Those are the 3 standard options that are available. Programs and products. Service contract reimbursement insurance policies that are used today to satisfy state financial requirements for many different types of products. Examples are listed here: appliances, electronics, Internet of Things devices, exercise, sporting goods, jewelry, musical instruments, automobiles, trucks, various parts and accessories, boats, jet skis, ATVs, motorcycles, snowmobiles, recreation vehicles, just to name a few of the items. Multiple structures exist for how to use a service contract reimbursement insurance policy, and that's on a case-by-case level, how it gets structured. There are additional requirements exist, and a complete review of the regulations does need to take place. Again, this is merely meant to be an overview of a service contract reimbursement insurance, the statutes of some of the states, and how the service contract reimbursement insurance policy can satisfy those requirements. For additional information on how to utilize a service contract reimbursement insurance policy, please contact me, Mike Frosch. My email is mike@personalsafeguards.com. Thank you.